Good afternoon. Welcome to the weekly take on the market. I will be your host. My name is Scott St. Clair. I'm Senior Manager at Premium Product Group here at Investors Business Daily. Uh, this is a little bit of my background. I've been involved in the markets for quite a number of years. This is the disclaimer. I'm not licensed. Nobody that I'm aware of at IBD is licensed. We don't make buy, sell, hold recommendations. Our sweet spot is research, education. Please take a moment to look at this. Okay, so we'll talk a little bit or a lot of bit about the overall market. I have a few slides. I took last week off because of the Stay in Step webinar that we do every month with my colleagues. And so have a little bit of stuff that I saw, whether it was on Twitter. Almost always I get these screenshots from Twitter. Twitter's a great source of, well, there's a lot. You need a filter for sure, but there's a lot of information there. Then we'll get into the industry groups, stocks to watch, and the quote of the week. Pretty much the same routine. So tech from B of A is stretched to the upside versus the S&P 500. I did see today, somebody said in the first quarter that energy actually outperformed tech. Now, I don't know what they consider energy and what they consider tech. Maybe the broad S&P category of tech versus and energy, but I thought that was interesting. But tech has been the place to be, at least so far in the last 12 to 18 months, led by the AI stuff, NVDA, et cetera. And, it's pretty stretched. Now, how would you trade this? I wouldn't know how to trade this, but it's just food for thought. These are things you want to kind of build a model in your mind of how the market is working. And a lot of it is, if I'm reading about it on Twitter, a million other people are reading about it on Twitter. Everybody already knows this, but I like to know what they know. There's an old saying, I might butcher it a little bit, but you get the idea is if you know it, it ain't worth knowing, or something like that, right? So it's built into the price for sure. So everybody knows that tech is overvalued and, well, relative overvalued, and has been for a while. Chip stocks relative to the S&P. Chip stocks fall in that same category. Again, NVIDIA and some of the others. And they finally reached their 2000 peak compared, like an overlay versus the S&P 500. You hear this a lot, that the market is narrow. I don't really believe that. I think there's a lot of stuff that it can or should have, or we wish we would have bought, from home builders to building materials to cement stocks to energy infrastructure to shipping to Tidewater in the oil sector, NVIDIA, ServiceNow. So that's kind of what I see, but this is a chart, and if drawn correctly, the facts are the facts. Top 10% of stocks make up the entire, or versus the entire U.S. stock market. So it is top heavy when you include the entire universe of potential stocks. Now, for us, we don't need the entire universe of potential stocks. I'm looking for 8 or 10 really good ones. You might be looking for 12 to 25 really good ones. Somebody else might be looking for 30 really good ones. If you're looking for any more than that, then you're probably running a mutual fund. So there's a lot of potential leadership, and has been for a while. But overall, there's the haves and the have-nots in the stock market. I pulled this from a book I was reading. I really like this because the market's constantly changing, and you like Wayne Gretzky would say, right? Skate to where the puck is going to be. Skate to where the puck is going to be, not where the puck is. So right now the puck is in tech stocks. Where's the puck going to be? It could still be in tech stocks. That's not an impossible scenario. but you want to kind of skate to where the puck is going to be. And so in 2020, these were the best stocks. Carrier Global, I haven't seen that on my list in forever. NVDA, Generac, PayPal fell by the wayside. Albemarle fell by the wayside. Etsy, Moderna, Enphase, Tesla. So if you owned all these stocks in 2020, you had an incredible year. But as you sit here today, you're licking your wounds on all of them except Nvidia is my guess. I didn't look, but it just from all the work that I do, my observation of the market. I know Tesla's way down. I know Enphase has gotten beat up. Moderna got beat up. I don't know about Etsy too well, but Solar Edge, PayPal, I know is fallen by the wayside. So skate to where the puck's going to be. In 2021, what were the best stocks? Devon, Marathon. Nobody was looking at those in 2020. Fortinet, Ford. Wow. And these are, S&P 500 stocks. So it's not, there's a filter here. It's not, the small biotechs. Bath and Body Works, Moderna again, interesting. NVIDIA again, Diamondback Energy, Nucor, steel stock. Who would have thunk, right? And then the following year, still had a lot of oil and gas, but they were different. Occidental, Constellation, Marathon, Schlumberger, Valero. Look at that. It's the entire list is oil and gas. So for 2023, what it's going to look like, probably going to have NVIDIA on there. And so the market's just, you got to stay in sync with what the market's doing. You got to look at where the leadership is, follow the group strength, stocks at or near new highs, relative strength. There's just no way a stock's going to be one of the best performing stocks of XYZ year and not have strong relative strength. All right, this is pretty busy chart. You might want to pull it up, do a search on it. It's from B of A Global, but a lot of the stuff you find on Twitter, I don't know. It seems with a kind of a bearish tint. So I like this one because this one is more of a bullish tint and drawing these large consolidations. Then you have these secular bull markets, large consolidations, secular bull markets. I remember there was a webinar we did a long time ago with Bill, 2011, 2010, 2012. I can't remember the year, but he had one of these charts where he was looking for a long secular bull market, and boy, was he right? Right, we've been in one. It was some hiccups along the way, but truly since 2009. So this is just extending out based on the rule of a 14-year secular bull market out to 2027. Again, can you trade on this? I wouldn't, because what if you're wrong? You could get run over. Like Jesse Livermore used to say that speculators lose, but it's the long-term buy and hold investors that get crushed if they get it wrong. So they just stand on the railroad tracks and see the train coming and don't do anything. So you want to read the tea leaves. That's why the best way to do this is just to observe what the market's doing day by day, week by week, month by month. I think that's it. So let's jump into the charts. And here's the NASDAQ. So day by day, yesterday was a very weird day. I don't know if it was news related. There was some talk of geopolitical news. And then you had the, I guess the jobs report this morning, a government number that, I knew was going to move the markets. Didn't matter to me what the government number was. And so you had a really kind of an air pocket yesterday. The market really air pocketed, and then it spent the rest of today going up, which is what normally happens. It's really weird the way it does that. You don't get that much follow through on really bad closing days. I can give you numerous examples. I guess that closed at the low and you got a little bit of follow through day there, but look at this, closed at the low. That was the low of the move. Closed at the low, you had one day. Closed at the low, up the next day. When I see really big bars that close at the low, my instinct is to get short for the next day because that used to work. And lately my instinct has been, don't do that. It's not going to, there's not going to be any follow through to the downside. I guess if it starts to get some follow through, then maybe I will start to want to get short. But when you get a day like this, that'd be a really large bar or sort of large bar, closes at the low lately, and it, there's a tailwind. We're in a bull market still. The next day is, you're not going to get any follow through day. Now, if you're getting hurt in some of your names, you might have to lighten up. You have to do something just in case. But that doesn't mean you have to put on risk, right? There's a difference between taking off risk by reducing your longs and putting on risk by being short. So we're right at or near the 50-day, right at, or near the 10-week line. So let's see how it holds up. I think my instinct is to give the market the benefit of the doubt, but I'm not really that heavy in tech stocks. So I don't know if the NASDAQ is a great proxy for where I'm positioned. So let's go to like the S&P, and you can see it's holding up a little bit better. There's a little bit of white between the moving averages. It too closed on the low, spent the rest of the day going up. The Dow, the diamond, actually closed below the 50 days. So I think if you wanted to be short or have short exposure, I think this would be the area. Didn't close as well as the others. And then the Russell, I just am not a big fan of the Russell. I just don't like the composition of that. I've said that out loud a handful of times. David Ryan on IBD Live and Mark Minervini on our webinar on Wednesday talked about the MDY. They acting much better. So you can see if you want smaller exposure outside the big indexes, this one looks like it's acting much better. Let's gold. Gold is fooled everybody. No eyeballs on it, breaks out, nobody interested, and it's done really, really well. So it's pretty stretched at this point, but I watch gold. I do trade it once in a while. It's not that easy to trade gold for sure. But something about gold in this move that I've noticed is usually you get like little head fakes. Like gold doesn't break out and run, right? So if you bought there, you gave it all back. If you bought the strength here, you gave it all back. If you bought the strength there, you gave it all back. If you bought the strength there, you got crushed on this move down. You bought this little consolidation, that didn't work. If you bought the double bottom, that didn't work. Maybe you buy the undercut shakeout here. That would have been much better. So let's but here you buy strength, closes on the high. That didn't work. And you get the idea. It's very difficult. But guess what? This one worked. Closes on the high, goes up the next day, goes up the next day, goes up, goes up, goes up. Now it gives back, but look at how little it gave back relative to these other ones. So let me redraw this. So you can see like this is the only one that looked potentially like that, but see how the steepness of the give back versus this give back. That was kind of a tell in hindsight. And so it's very, very strong. Just need to consolidate, of course. And there's some stocks that are acting okay in that area, but you have the bond market, which is not acting all that well. When I say not acting all that well, it means interest rates are climbing. The TLT is the reverse. And it just doesn't seem like the Fed is going to cut 3 or 4 times this year. We're running out of real estate for that to happen. It's already April. And the market is digesting that news, I think, and getting used to it, which is kind of what's been happening for the last couple of weeks. So that's the overall indexes. I don't know. I think the indexes are a bit tired. I think the leadership is either congesting, best case, topping, worst case, SMCI and NVIDIA's and ServiceNow's of the world. Meta sure doesn't look like it's topping. So it looks probably like a congestion with another leg, and we'll see which ones participate. Some of them will not participate if there is a second leg. Let's jump to the industry groups. Reverse the sort. Computer software database is 1. Computer hardware peripherals 2. That's SMCI and Dell. Dell is acting very good. Building maintenance services, only 12 stocks, but number 3, apparel shoes, that's Deckers, etc. Semiconductor fabless, doing well. Building construction, doing well. Computer data storage. So there's some growthy groups, which is what I like to see. Finance card, kind of a bifurcation. KSPI has done really, really well. A new name, but PayPal's and those are not really participating. Retail restaurants been a strong group for sure. Wing, Shake Shack. Those are the 2 that I can think of off the top of my head. I know there's others. So the group constituents are fine. I think there is stuff to buy if you're, using kind of that group mentality of where the best stocks are. All right, so let's get into leadership. I'll turn off my camera so you can see some of the stocks better. And we'll start with NVIDIA, and we're getting close to a potential base. Let's see. So we have now, because Mark Surge is looking for the first week down to start counting, this is week 2. But since it didn't make a new high there and a new high there, to me, really, this is week 1, 2, 3, 1, 2, 3, 4. If you're going to count that week, it's 5, right? It gets a little tricky here, but this is potential base, bottom line. And you're getting closer to that moving average. I was hoping, again, I always love shakeouts because it really helps you to see which stocks don't want to go down. But a shakeout down to the 50-day today would have been beautiful. I wasn't optimistic. It closed on the low. In the old days, I would have thought that could happen, but they saved it today. So NVIDIA is holding up. It's the leader. If you own it and you're a long-term holder, it hasn't done anything wrong. You're just sitting there, waiting. If you're trying to get in like I am, I don't own any longer, then I'm looking for either a new base or ideally I want some type of shakeout pullback to the moving average. I mentioned SMCI, kind of the same thing, not as good a base action as NVIDIA, but it's more dynamic. This stock really, really moves. The size of the company is different than NVIDIA. So it's getting a little close to the moving average. You also have a new one in the semi space. And full disclosure, I bought this stock today, which is Astera Labs, A-Lab, and it looked like it started to go and then pulled back a little bit, but it's not, there's no base here. It's kind of a cheat buy for me. I had kind of a trend line alert there, but look at the quarterly earnings and sales, minus 50, plus 60, plus 148, loss, 9 cents. That appeals to me. I haven't investigated this, but I'm curious about this insider buy on the IPO. So I might have to try this a couple of times to get it right, but I'm willing to try because I feel like this has potential to be a very asymmetric trade. So this is a newer name if it's not on your radar to watch at least. I did mention the gold stock. So AEM to me is the best one. I do own AEM. There's others that can be owned, but coming out of the space and holding the gains so far. SCCO, really good breakout, up 27%, it's currently 25, but it did get to 27 and in 3 weeks or less. So if you follow that rule, you're going to keep this for at least 8 weeks. You've got the ant there. I'm curious about copper. It makes sense to me. if you've read anything about copper, like if I found a copper mine in my backyard, it'd take like 20 years to get it out of the ground with the regulation and all of that. So if the price were to get going, it's not like they could create a bunch of supply in a hurry. Is the thesis right or wrong? This is another one in there. ERO, FCX is another one in that group, but it looks like SCCO is the leader. If I go to the monthly, this is the all-time high for that stock. What else? Tidewater is the leader in this group. I don't own this. I've messed this one up. One of my favorites in here, and I did fine in it. This space got it really tough, and I just kind of this is what usually happens when you're looking and then you take something kind of off your radar because it's underperforming for a while, and then boom, you got to have a plan somewhere. That was the time to buy that, if not there, on the consolidation after a number of days. 80 to 100 if I was paying attention. So this is the best stock in this group, I think. And look at the quarterly earnings and sales are really, really strong. So that's a great name. Energy infrastructure, CEG, I do own this one. When you get this, I was like looking at a lot of these bars, and almost always when you get a bar like that type of strength, that type of accumulation, you fast forward 3, 6, 9 months, the stocks are almost always higher. Now, how you get into them, how do you handle them, how do you hold them correctly? It can depend on the market environment. Sometimes they go up like that and just sit there for a while. And not all of them work. Some of them fade, but I saw that with a bunch of other, I was trying to replicate that kind of bar in a screen. And I just noticed that there are a number of names that have had that kind of strength, and where you see that and you just want to, if you like the name, BWXT is kind of in the same area. Now this, after its bar, it's gone really kind of sideways, hasn't done what CEG has done, which is why my exposure, right or wrong at this point, is in this one. What else is out there? Let's talk about like Tesla. I know there was a rumor or an article in the Reuters that they were discontinuing the lower priced car, and then Elon Musk refuted that and stock came back. Dead money. I don't know if you want to be short this at this very moment, but I just don't see any reason. There's just nothing compelling to be long. It looks like a short to me, but the problem is the market. Swimming upstream a little bit, and the time to short it was like when it rallied here, when it rallied here, when it rallied there. You just really don't want to short it when it's making new lows. One way to watch it, because seeing a short pattern is a little difficult, is some of these stocks have these reverse ETFs, and here's Tesla Q. It looks like really just kind of a giant cup with handle. So maybe if it got above 42.05, you consider shorting it, or in this case, buying TSLQ. This is a 1-for-1 short, so it's not leveraged to the short side. And I've been in this one before. So that's Tesla. Apple looks like a short too, but again, it's so big. It's in all the indexes. It's just like, I'm not certain how much downside there is, barring a bear market, but I just don't see any point in owning this one. So the Mag 7 is at best the Mag 5. I would think I could say with some confidence Apple and Tesla don't deserve to be in that. What else is in there? Amazon looks fine, or actually good. Google, it's okay. It's not really going anywhere, but it's not hurting you. Meta is a superstar. And Microsoft is a big cap superstar as well. That's kind of makes up the whole group. So this weekend, do some work. You've got your open stock ideas. You've got the growth 250. Be a great place to search. Stocks at or approaching new highs is a great place to search. The William O'Neill screen, the Minervini trend template. You also have this favorites button, which is really cool. Not, excuse me. What this does is it allows you to add your favorite screens, reports, lists, so that you're really organized. So if I click add, I can say, I really like to look at the growth 250. So let's go ahead and add that to my favorites. And this is what these are some of my personal screens that I've created, but I do look at the growth 250 every week for sure. And so I start from here and work my way down. And if it's 1,000 stocks or 1,500 or 500, I space bar through all of them every Sunday afternoon. Now, it won't be 1,500 unique names. VRT, NVDA, ServiceNow, they can be on more than one list, sometimes 2 or 3 or 4. That's fine. If I see the stock, I can easily just space bar and move on to the next one. So if you're not familiar with that favorites, how that works, that's what that's for. You just hit add, and it'll default to list, or I can go to screen and I can say, oh, in my screens, I want to add my Taylor screen. And there it is, 2 stocks. Or 0 now. And this is that screen I was looking for, that really big bar higher that I talked about with CEG. So there weren't any stocks that did that today. So little tidbit on how to keep yourself organized and finding some of these ideas, because there's nothing worse than when you stumble upon a stock that you would have bought that you don't own, and the reason you don't own it is because you just didn't see it, didn't come across your desk, is what we used to say in the business. Okay, I think that's it for now. There's plenty of other leadership, but those are the ones that jump out to me at this point. All right, so the quote of the week, Dan Rasmussen, Verdad, I believe, is a hedge fund. He's a portfolio manager of Verdad. It's really, really hard to predict the future. If you're a smart quant and can backtest things, you can put in a lot of ideas and see how hard it is to predict the future by looking at how many of your backtests fail or how many of your good ideas don't work. So it's really hard to know what the Fed's going to do, what the fiscal policy of the U.S. government's going to be like, what the geopolitical concerns are going to be like, and in the end, what the bond market's going to do. And that's why what Bill would say is just observe. I like to read all this and look at this, but in the end, I put a lot of emphasis on the price action of what the instruments are doing, right or wrong. They can fool you sometimes, for sure, but that's, I think, the best that you have to work with. So me and Arusha did a podcast about how hard it is to predict, and what Scott O'Neill would say often, all the time, is we don't predict, we interpret. So what is the market doing right now? Right now, the market is a little tired. It's not in trouble. Had a bad day yesterday and had a pretty good day today. It's above the moving averages. So just that alone tells me that, yeah, I can be invested. Maybe I don't have to be 100% invested. I think IBD has their exposure at 40 to 60, maybe. If it's not 60 to 80, it's somewhere in that range. And I would say I'm probably somewhere in that range. But I have a couple of, for lack of a better term, special ideas, because I just don't see these names as being all that influenced by the indexes. So I don't know how I would qualify that type of exposure. But yeah, if you think, I used to keep journals. I have some of my old journals from a long time ago, And it's funny if you read what you thought, and have a lot of notes from when I was a portfolio manager on that team at William O'Neill, and these are the thoughts of the of the best manager of portfolio managers at William O'Neill at this day and time. And guess what? They don't get it right every time either, but they pivot quickly and change their mind quickly. So that's what's most important. All right. So our contact information, 800-831-2525, marketsurge@investors.com. I believe I'll be back next week. Thank you guys. Have a great weekend, and we will see you on Friday. Bye-bye.